Hi, everybody. Welcome to our monthly market insight for June. What we're going to kind of talk about today is really just a temperature check, what's been going on in the markets, kind of what our outlook is for the rest of the year, since we're almost halfway through. And so Sean's going to kind of walk you through a presentation and kind of go through, we were talking about this a little bit before this morning, Sean, it's a really unique kind of time right now, right? You have, inflation going down, investors tied to the Fed meetings and the rhetoric and what are they going to do with interest rates this month. You have your bank failures that happened at the beginning of the month. And now that we kind of look at performance, it's really 7 major tech companies driving the rally so far this year. So Sean, if you don't mind kind of going through our presentation, just giving everyone that's on here that'll be getting this through email and recording, kind of your take on what's happened so far this year and what our outlook is.
Yeah, thanks, Nora. Yeah, so it's a very unique time. We saw inflation kind of peak last June at about 9.1%. Last month, it did drop down to about 4.9%. So we've seen inflation steadily decrease. We've seen the Federal Reserve raise their interest rates, talk about potentially pausing. We've got a lot of things happening in the economy, and that's what we're going to kind of talk about right now. So yes, the markets have been positive for the year, as Nora mentioned. Really the tech, the prospect, if you will, of artificial intelligence and how that will impact our future lives, potentially driving some tech stocks up, but really pulling everything else up with it. The S&P 500 is up mainly because the NASDAQ is up almost 3 times larger than that. So the tech industry tends to be pulling us up this year. There's a lot of weird economic factors going on. The news is really scary right now. And I would say that the market's very confused. There are a lot of variables that are going to be coming to a head here over the next 6 to 12 months. And so we just want to kind of talk about some of those things, show you some data behind all of it ultimately, because it doesn't matter what's happening on the news. We need to talk about data and what the facts are behind it. So, right, one of the things that's very unique and things that we've been hearing that's really scary is the banking industry. So the first quarter of 2023, we saw some banks go under, but overall, we want you to know the U.S. banking system still looks very healthy, right? So we can see that kind of tier bank capital ratio is still very high compared to a year like 2008. What that means is banks have stronger assets. They are much more capitalized to be able to withstand any type of downfall. But one of the things that is happening is we're seeing a much higher increase of consumer lending, right? And really all lending by banks. So banks are being it's much harder to get a loan now than maybe historically, right? We saw 2008 things get really hard. We saw during first quarter 2023 things get really hard, and we also saw that kind of during the COVID years. So banking lending is not going to happen as easily, and that could hurt consumers from going out and getting loans. That could hurt banks. That could hurt companies from borrowing money so that they can continue to hire people, do research and development, continue to drive their sales. So we're seeing banks don't look as scary, right? We see that more as a regional kind of focus. That was more that banks, those particular banks, did a really bad job of managing their deposits, and they had a high concentration of their depositor base that was tied to technology, that was tied to private equity. And as those things cooled off, those companies started to pull their own money from the bank so that they could run their businesses, which hurt those particular banks. So maybe one of the things that comes out of that is stricter lending, stricter banking regulations, because when we buy a bank in our stock, we don't really know if they're over-concentrated in a particular industry. So that kind of explains the banking industry so far for the year. One of the other things that we're seeing is the U.S. economy could be at a greater risk of kind of slipping into a recession. We've seen this, we've heard it. We've kind of went over what defines a recession. Ultimately, what the government is kind of using is how does unemployment increase, right? Does it increase by more than a percentage point over the previous 12 months low? So just on Friday, the unemployment number came out. It increased slightly by 0.3% up to 3.7%, which is still a very, very low rate. And we did add about 319,000 new jobs. So we see kind of some conflicting news. Good jobs kind of growth, unemployment getting a little bit weaker. Hopefully, that will lead to the Fed maybe not raising interest rates, right? Lowering interest rates to allow for some more consumer spending. Because one of the things I want to kind of point out is what the largest component of our GDP, 2/3 of it is consumer spending. That's you and I going out, spending things, buying things through Amazon, going shopping, traveling. That's what drives a large part of the US economy. What we're seeing is that the average savings rate, right, is down to about 4.7 from a historical kind of long run average of about 8.9. So people are saving less money, and we're also seeing credit card balances be much higher, people not pay off their credit card balances. So do we have a lack of capacity for consumers to go out and spend money? Does that ultimately hurt companies' revenue growth streams down the road, right? Those are some of the things that we're monitoring here. One of the things that's kind of an intended consequence of the Federal Reserve raising interest rates, right? They wanted people to stop spending money so that inflation could come down, and it's happening. So we're trying to see, does the Fed get the lowering of the interest rate at the right time so that we can allow consumer spending to continue on, right? Again, a very, very interesting time period for the economy because we've got banks kind of tightening up lending standards. The Federal Reserve raised interest rates. Inflation's coming down, which is a good thing. Consumers may be lacking the ability to spend money. We've been hearing about in the news, can we get that soft landing? We may be at the point where the Fed's trying to time up. Are we able to get that soft landing? Is this the time period to get the soft landing by lowering interest rates back to increase consumer spending and increase people's savings rates? Right. So we'll go ahead and look at kind of some, unemployment and wages. So what you see is we've seen good wage growth. That's been one of the things that's happened with some of this inflation is that wage growth is finally happening. It took a really, really long time period for wage growth to kind of get above its historical rate. So people are getting more money, right? That should lead to more consumer spending, should help drive the economy. But we're also seeing the unemployment rate still at a historical low. We saw back in kind of the COVID years up at about 14.7, very, very short time period, came right back down to a historical low. So it is slightly ticking up. That's how the Fed will define a recession. That's the number the Fed's going to use to kind of decide, do they lower interest rates? Do they leave interest rates where they're at? Because they want to make sure that they're imparting some pain in the economy to slow down the inflation. They don't want it to be too much that they drive us into a recession, right? That soft landing. So we still have historically low unemployment. We still have some pretty good wage growth from historical numbers, right? So all, again, good things so far from the economy. All right, we also have kind of some corporate earnings. So we've been hearing, right, that we kind of just got through our earnings season, and we saw S&P earnings kind of continue to be challenged by a little bit of slower growth. So lots of growth there during the 2020, 2021 market was doing really well. People were really happy. We're seeing some of that revenue, some of those that slower growth for some of the companies' earnings. And again, that kind of reflects what's happening in the market. We see tech companies going up really high, but the rest of the market is relatively flat. So we actually think the market is attractively priced. We see some places, some asset classes that have some unique valuations in it. One big part of that has been this inflation heat map, right? So we see inflation is gradually falling to manageable levels. Back in June of 2022, we saw inflation get up to a high of about 9.1. That has slowly cooled off to where we're at kind of through this first quarter of 2023, and things have really cooled off. Now we're still seeing some sectors, primarily medical services, properties, home, real estate, those things still tend to be high. And interest rates are at 7%, but we had a client just say that they lost a house to someone who paid $30,000 over asking. So those things are still happening because we have a lack of inventory in the housing market. So there still is a very unique time period. Does the Fed lower interest rates, drive down home mortgage rates? Then all of a sudden we got this rush of people going to buy houses with still a low inventory. So again, a very, very unique time period in the economy. But the good news is things like food and energy, those things are coming down. I'm not hearing as much complaining about the price of milk and all those things. It did get pretty crazy in 2022. So inflation is cooling off. Again, that's really what's been leading to a lot of the growth so far this year in the economy. The Federal Reserve interest rates are starting to get to the end of its tightening cycle. So the Fed last month announced that they're going to do an additional 0.25% interest rate hike. They said that in their March meeting. However, it toned down kind of its guidance on if it's going to further tighten, right? Is it going to continue to raise interest rates? They were very, very vague about, hey, we may be willing to consider not raising them or maybe take a pause. So those things have played out and the market got a little bit excited about that, but then we had some slow earnings growth, but all kind of really good things. Fed starting to say, hey, we may lower interest rates, we may pause it, inflation's coming down. Those were the big herders of the market in 2022. Those things tend to be trending in the right direction. So again, kind of mixed signals overall in the economy. The other thing is kind of the global central banks continue to fight inflation. So it's still happening. So we mentioned that inflation in June of 2022 is about 9.1%. Last month, the announcement came down that it dropped to about 4.9%. We're going to get the next number on June 13th at 8:30 in the morning. So that's another big number that we're watching. Does it fall from 4.9%? The Fed has announced that even though they've been raising interest rates, and we have interest rates higher than inflation right now, which has been the first time in a really, really long time we'll be able to make that happen, that they still are very motivated to get the inflation rate down to about its historical average of about 2%. So the Federal Reserve wants to get that number down quickly, and it's still at 4.9%. So it's still more than double what the Fed wants it to be at. So the question is, how do they continue to raise interest rates, not inflict too much pain on consumer spending, not inflict too much pain on bank lending so that the economy continue to grow, right? Those are kind of the big challenges and things that we're watching so far this year and in the remainder of the year. Another thing that's really been happening is we're getting a new cycle of kind of dollar getting weaker, right? So we've seen the dollar kind of trend really, really strong as the Federal Reserve was raising interest rates. We've seen a lot more people put money into like money markets and CDs. We've got a lot more of those calls. You're going to see a lot more banks come out and say, hey, we've got this higher interest rate savings account of maybe 3%, 4%, 5%. Banks really since 2008 have only been able to pay 1/4%, 0.5%, maybe 1% if you're lucky. Finally, with all the raising in interest rates, they're able to go out and offer some attractive savings rates. So we're seeing more people put money into kind of very, very safe cash kind of investments like money markets and savings accounts. As people have bought treasuries, as people have done that, the dollar has gotten a lot stronger. So now as the market starts to change, the Federal Reserve is start to lower interest rates. Do we see the US dollar start to get a little bit weaker? We've started to see some of those things so far throughout the first quarter of 2023. When that happens, it takes more of our dollars to buy international goods. So international markets could be a really good place to buy things. So really the story of 2023 was we had a continued volatility even from 2022, but we've had a few market sectors that have really kind of been pulling us out of that weakness. We also had some uniqueness with the small regional bank throughout that first quarter. We've seen elevated inflation start to come down. We've seen monetary policy start to tighten. So all of those things sent the markets through some twists and turns, but we still are off to a really, really strong year, right? Markets are still up over 7% for the year, and that's led to a really, really good turn, right? If we could get 5% every 5 months, we'd be the happiest people in the world. So overall, good picture, but a few sectors have created some turmoil and a few sectors have pulled us up. Again, that's the power of having a diversified portfolio, not putting all your eggs in one basket, right? Many sectors will perform at different times. All that being said, there are some certain asset classes that tend to be really good performers. So I think this is a really neat chart, right? The dark green is kind of its current market valuation compared to its 25-year historical average. The light green here is based off of December 31st, 2021. That was the last day of the last market high, right? So one thing we've been telling people is every time there's been a market high, there's always been another market high, right? Now, certainly, right, there's no guarantee that that's the case, but it's always happened, right? So we know that will be the case. We just don't know when. It might be this year. It might be in 4 years. We don't know that. But this was kind of its last valuation. This is where things are kind of currently at. So things like U.S. growth, that would be your NASDAQ or high tech companies. They may be a little bit overvalued right now. The same would be true with U.S. large cap. That'd be your S&P 500, high yield bonds, kind of U.S. value, municipal bonds, and U.S. small cap all seem to be kind of averagely priced. And then international equities, treasuries, emerging market equities, core bonds tend to be undervalued right now, right? So we saw the bond prices come crashing down in 2022 due to rising interest rates. As those rising interest rates start to fall from the Fed, those may be really good places. If you don't like bonds now, you may never like bonds, okay? So there's kind of some unique asset classes that could be there. Another thing is we've got a lot of volatility in consumer confidence about the economy. So consumer confidence throughout the economy is at a low. Historically, right, when we've been through some lows, consumer confidence has led to really, really high markets. So people tend to in the market and they get a little bit scared about recessions and the economy not doing so well. They should be saving more, right? They tend to invest a little bit more, and that's led to some really good things. So it'll be interesting to see how does this play out. Obviously, we would never say, hey, just because it's down, go buy. But historically, consumer confidence being low long term has been a good thing for the economy. So we've got a lot of kind of uncertainty, a lot of people moving money to money market CDs, cash savings, a lot of people uncertain about what's going to happen in the economy, and rightly so, right? We've got kind of these macroeconomic factors between the Federal Reserve changing interest rates, how long do they continue to raise it? Do we continue to see inflation come down? And how will that impact the market overall? And how do banks navigate lending? Do consumers still continue to go out and spend, even though we may be losing some capacity? So a lot of uncertainty in the market. Typically, that will lead to some volatility. So we may see some volatility here over the next 6 months for this year after having a really, really strong to the first part of the year. So that's really kind of been the overall story of the economy and kind of some data behind it.
Appreciate, John. That was great. For anyone listening, or when you get the recording, if you have additional questions or comments, please reach out to Sean and I. That is it that we have for this monthly Market Insight. We'll see you right before the 4th of July. And a special thank you to all of, I know we have a lot of clients that are in the military and veterans with the anniversary of the D-Day tomorrow. Just want to say thank you, everybody. Thank you, Sean, for your service. As always, questions, please reach out to us, and we'll talk to you next month.
Thanks, everyone.